Hello, this is Julius from Basic Financials. This video is about company pension contributions as opposed to personal employee contributions, and I'm really focusing on where it's your company, so it's a private company where you're a shareholder and a director, and therefore you have control of how you take the money from that company, whether it be through salary, dividends, or in this case or whether you decide to take pension contributions. Now, the difference between employee contributions and employer contributions is quite important, and when you make these contributions, it's important that you tell the provider that whether they are employee or employer. With an employee contributions, I've got different videos here about employee contributions. What they do is you pay them out of your taxed income. So you pay an employee contribution, say £8,000. That will go into your pension fund, your personal pension fund. The government will add 25% to bring that up to £10,000 gross. That gets added by the pension fund claiming the tax relief on your pension contribution. So you've had 25% tax relief at source effectively because you've paid 8,000, but you've got 10,000 in your pension fund. Now also another benefit is that £10,000 also increases your basic rate band. So if your income is over 50,000, say you've got income of 60,000, you'd normally be paying tax at 40% on, or higher rate anyway, on 10,000 of that. If you paid a pension contribution of £8,000, that's treated as 10,000 gross, and then you get your basic rate is also increased to 60,000, increased from 50,000 to 10,000. That's the limits for 2019-20 anyway, for that tax year. Now, with a company pension contribution, you don't receive the income in the first place. You get your company to pay the pension contribution directly to your pension scheme, and you tell the provider that it's coming from your company and it's a company contribution. Now, what happens there is you don't receive the income, therefore you don't get taxed on it in the first place, and also you aren't paying national insurance on that contribution. And then the company will get corporation tax relief as an expense on that contribution. So the company will get, so if say the company's corporation tax rate is 19%, then it will get 19% tax relief. You will end up with 10,000 in your pension scheme, and no extra gets added. Because it's an employer contribution, but the company will get tax relief at 19%, corporation tax relief. So it's something that's worth bearing in mind. And if you've got your company will have a year end, a financial year end. It could be anything that you decided it to be. So say it's the 31st of March, and you want tax relief for your company in the year to the 31st of March, you need to get that pension contribution paid by your company and into the scheme by the accounting reference date, i.e. in this case 31st of March. You might not have a 31st of March, could be 31st of December year end, in which case you need to get that company contribution paid by 31st of December. If it goes in the following year, then you get tax relief in the following year. So you still get tax relief, it's just delayed by another year. It makes no difference from you personally, because, as I say, you're not getting any extra tax relief, so you don't need to worry about the 5th of April as a deadline. There are limits to the amount you can put in. I won't go into details because it is quite complicated, but basically, if you're receiving a salary of say, well, less than the additional rate of, so you're not earning more than 150,000, let's say, including the value of pension contributions, then you can pay up to £40,000 a year. So your company can pay £40,000. Now that's another benefit, because if you own your own company and you're getting a small salary, say £8,500 a year, and the rest you're taking out in dividends, then you would be limited to £8,500, because another limit is how much you're earning if you're paying employee contributions. So to get round that limit, you could get your company to pay an employer contribution, and the limit there would be 40,000. There are some other complex rules that you can bring forward from unused relief from previous years if you've had a pension scheme up and running, and there's also other additional limits if you've started to draw money out of a pension scheme. Might bring it down to a £10,000 limit, and there are other complicated rules as well. So I'm not going to get into that. The basic thing is that you're paying employer contributions from your company, which can give you a more amount to pay if you want to. Yeah, so that's a little bit on company pension contributions. Where's your company? If you've got any questions or comments, please leave them in the space below. And like and subscribe as usual, please. Thank you very much for listening, and I'll see you again for another video soon.